Hello fellow human, nobody here with a new stock analysis. Today's question is in the minds of many, and it infamously gets the most emotional answers, both positive and negative. Should you buy Tesla shares? As always, I will jump straight into my verdict and I will give you my reasons afterward. Ready, set, go! Around today's price of $198, Tesla stock is a buy. My price target is between $200 and $260 for an average of $230 per share. This means that I find shares attractively priced as long as they stay within or below this range in the coming 12 months. Tesla has been a controversial company for a while, and the stock's volatility has reflected that. Of course, when I say Tesla, I mean Elon Musk in all his space cowboy majesty, and by controversial, I mean that some people believe that Mr. Musk is a fascist, because everything that goes against communism is right-wing, and therefore libertarianism and fascism are pretty much the same. And some people believe that libertarianism is the opposite in every way of both fascism and communism, which in turn, when put into practice, are really similar. Who knows where the truth might be? But anyway, are political views really what is moving the share price? Or is this just a convenient explanation for the volatility? Let's answer this, but first, a little disclaimer. If you're watching this, I assume you're not a lemming, but a sovereign individual. Nobody can tell you what to do with your own money. I only provide you the tools to take financial matters into your own hands. You alone are responsible for where you place your time and money and trust. So no, this is not financial advice. This is just how nobody invests. No, I don't think political views play a significant role in Tesla's share price fluctuations. I believe the reason is that Tesla is a story stock more so than most. That means investors' confidence in the long term of the company is very sensitive to every piece of news that comes out. And so the share price goes up and down a lot based on every little thing that the company says or does. And again, when I say the company, I really mean Mr. Musk. But before we go any further, let's take a look at the company's past growth. In the past 10 years, Tesla's average annual growth was 47.3% for revenue. Earnings, on the other hand, became positive in 2020 and have grown very fast since, as the efficiencies of the company's structure paid off with the scaling up of operations. Pause here if you would like to take a longer look at the chart. Pretty impressive growth, but will the company be able to keep up the pace? Let's check. For the coming 3 years, analysts expect the company's average annual growth to be 12.4% for revenue and pretty much flat for earnings. Both revenue and earnings are suffering because of harsh macroeconomic conditions and a major slowdown in sales this year. After 2024, revenue growth should stay above 15%. Not bad. However, here's where we need to address the one criticism against the stock that stands out. Many people say that Tesla's valuation is extremely expensive for a car company. That its valuation multiples don't belong in the automotive industry because in the industry margins are typically very low. And it's true that Tesla's revenue comes mainly from selling cars, and it's true that Tesla's margins are not high. Despite the company's very successful vertical integration, its gross margin was just slightly above 25% at its highest in 2014, 2021 and 2022. And then, with the last year's price cuts, it is now just 18%. Sure, the net income margin is impressively close at 14%, but that also means that the company has limited room for bottom line improvement if the gross margin keeps getting pushed down because of increasing costs and competition. And how are those valuation multiples looking? Revenue multiples are in line with the 10-year average, yes, but they are definitely too high given the company's current margins and revenue growth. And earnings multiples, well, the 10-year average doesn't tell us anything as earnings were in negative territory over half the time. And because earnings are dropping this year and staying flat overall for the coming 3 years, we cannot really calculate the PEG ratio. To recap, we've got a company with below 20% gross margin, growing revenue at 15% per year if we're being generous, earnings not going anywhere for the next 3 years, and multiples that would eventually make sense if the share price didn't go up. So how can I possibly consider it a buy? Here is where the story part kicks in. And the story is higher margins. How? Energy? No. Although the company will accelerate its revenue growth by selling its energy generation and storage solutions, like cars, utilities have embarrassingly low margins. Why the low margins? because many others can also do it. Perhaps slightly worse, but they can do it. To achieve higher margins, the company needs to offer something that others will struggle to replicate. Tesla's huge potential lies in all the data it is harvesting through its cars and the AI it is building with that data. And from that will come at least two key items. The first item is full self-driving. It doesn't seem like anyone can predict exactly when the key breakthroughs will take place, but Tesla will be a leader in FSD regardless of the exact timing. And the second item is, of course, say it with me, robots. The company has made huge progress with its Optimus humanoid robots, and it is already going to start renting and selling them pretty soon. These two items will have a profound impact on Tesla's valuation in the long term. In fact, they might start playing a relevant role in the company's revenue and margins as soon as 5 years from now. While that is too far away for many investors, the share price will gradually reflect the potential as time goes by and uncertainty is reduced. I have no doubt that returns will be pretty massive for anyone holding until 2030. The only question is whether you have the patience for that. At the same time, if shares quickly go up to $300 in the next few months with no major news, selling the shares should be considered. Yes, it is a very long-term investment, but we can and should take advantage of the market getting too excited or too pessimistic. If you found this video only mildly upsetting, please like it and subscribe to the channel for more. Share your thoughts in the comment section and let me know which stocks and concepts you would like me to explore in the future. If you have any questions, just ask. And until the next one, remember, if nobody invests, so should you.